Good morning, everyone, and welcome to today's webinar. For those of you who had the public holiday yesterday, I hope you all had a great long weekend and that you're all surviving the end of financial year rush. For those of you who don't know me, my name is Kate Salkeld, and I'm an associate with the firm based in our Sydney office. And joining me today to present today's webinar is Adrian Bailey, our managing principal, who is also based down here in Sydney. And in today's webinar, Adrian will be taking us through the different types of CGT rollover relief, those provisions that exist within the legislation. And Adrian will be taking us through the different kinds of restructures that are available, what are the different kinds of requirements for applying them, and what are some of the circumstances where it might be desirable to implement those kinds of restructures. So before I get Adrian to jump into that topic, we'll just run through a little bit of housekeeping, just in case any of you are new to this platform. So firstly, if you would like to download a copy of the PowerPoint slides from today, you're able to do so by clicking on the Files tab on the right-hand side of the screen, and you'll be able to download a copy of the slides from there. This month, Adrian has also been kind enough to provide a synopsis or a technical paper on today's topic. So you're also able to download that document from the Files tab in case you would like to do some more detailed reading on the topic. Also, if you have any questions that come to mind throughout the webinar, you're more than welcome to submit those just by clicking on the chat button, again, on the right-hand side of the screen, and you can type in your questions there. I'll keep an eye on them and I will interrupt Adrian at an appropriate time to put those questions to him. And last but not least, just a reminder that today's webinar will be recorded and it will later be uploaded to both our website and our YouTube channel. So just keep that in mind when you are submitting any questions. So without any further ado, I will hand over to Adrian to teach us all about the CGT rollover relief.
Thanks, Kate. Hi, everybody. Thank you for joining us today for our webinar. So asset protection is usually just one of the issues that's front and square in the mind of the business owner, and whether that's in the early days when we're looking to incorporate, whether the client has had a successful business for many years, or whether we're looking to consolidate and grow. One of the questions that will come up or will need to be considered is where we have the situation where we have the shares in a company that are held by an individual, and ways that we can improve our asset protection position or general structure to achieve our client goals. Now, with that in mind, the agenda for today and what we'll run through is client motivations and why they may be wanting to look at restructuring or having a look at their structure generally. Going through the restructure option recap, so we will be going through some CGT rollovers. We'll also be going through potentially a sale. We'll be going also through other options as well. So as usual with things in life, there's many ways to skin a cat, and having a look at which one is the best will depend on often weighing up the positives and the negatives of those approaches. Going off to a little bit of a couple of side notes there, having a look at how restructuring could potentially lead to further tax benefits down the track. Consideration of dividend policies, you may or may not have considered them at all, but consideration of them prior to a restructure through the lens of a Part 4A case and what was considered in terms of the client's dividend policy before and after the restructure. And stopping off with a further case study in terms of having a look at a client case study, the different options that may be put in, why we would do one over the other, or vice versa. So jumping into the client motivations aspect, as I mentioned, we're dwelling today in the world where we have a company with individual share ownership. Now, there's nothing wrong with that. And I guess the term incorrect or poor structuring to begin with might be a little bit unfair. But the reality is if we're looking at a structure through an asset protection lens and also a tax flexibility lens, a company with individual share ownership held by individuals is not ideal. Our motivation for our client may be that they're wanting to get out of this structure where they have the individual share ownership, or they want to increase tax flexibility. So having a look at some of the options that we could put in place for them. If we've got clients who have started in a company and have had substantial growth, they may be looking to consolidate and protect that growth, or they may have experienced claims themselves or seen other people experience claims and recognise the need to protect what they've built up. Sometimes it's part of family business succession planning, looking to restructure a family group so that we could look at some succession planning. And certainly that was the case in the Hayes case. That was a family succession planning exercise. Or it may be general concerns, whether that's macroeconomic or microeconomic concerns in terms of what's going on in the world or what's going on in their part of the market. And so with those sorts of things in mind, you can see that there's a number of different times that there may be the opportunity to discuss these restructures with clients. And it's not a set and forget type strategy where we've got clients in companies that we just leave them as is and we move on with life and we do the tax returns and we move on. We do need to be thinking about these other things and raising them with clients to see if any of these concerns are enough for them to look at potential restructure options. In terms of those asset protection concerns where we have individually held ownership of shares in a company, very often the classical mum and dad type scenario, we'll have a risk individual being a director of the company who also owns the shares in the company. So straight away that introduces the element of risk. If I'm sued for actions that I have taken as a director, then my ownership in the shares is also at risk. And recognising there is some interlapping there. Obviously, the value of those shares will be reduced if I'm getting sued for something I've done as a director. But also thinking about claims outside of the business, having our individual share ownership there is not great from an asset protection perspective. The other thing that it does is that there's a natural disincentive to declare dividends above effectively the franking balance or the franking threshold, so that there's additional tax to be paid by the client. So naturally, where you have a business that has been profitable for some time with individual share ownership, we often have a build-up of the retained profits within the trading entity. Clients buy assets where the money is, and sometimes there will be non-business assets or business assets such as property that are held within the trading entity. And the reason for that often is that, as I said, that's where the money is, or that's where the trading history is, and it's easier to get a loan in that entity. Again, if we've got our individual share ownership, that puts those assets at risk, but also the fact that we've got them mixed together within the one company is not ideal from an asset protection perspective. And similarly, if we've got multiple businesses within one trading entity, and you may wonder why people would start separate, discrete businesses within one trading entity. It does happen. Or it may be that the trading entity also owns shares in another trading entity. So all of these sort of scenarios should straight away say to you, well, there's an asset protection issue here, or this is not best practice. Let's have a look at some steps that we could do in order to improve the client's position. The restructure option recap. So what we're going to run through in the slides is one, which is not a CGT rollover. We're going to be triggering a CGT event, but doing it in a situation where the tax outcome is nominal or a smaller tax outcome. Having a look under rollovers under 122A, divisions 615 and 124, where you can't use 615, similar rollovers, but I'll explain why you may use one over the other, or may have to use one over the other, I should say. Division 328, small business restructure rollovers, having a look at those as an option, and then having consideration of other options that the clients may or may not want to do. And so what we'll run through in terms of the paper, we'll step through how each of these would work and how the rollovers work, where we're using rollovers, and then consider the positives and negatives of those approaches. So first of all, sale of an equity interest. And I think realistically, if we have a company with individual share ownership, then this would be our best approach if we can do it in a way that's tax neutral or there's only a smaller amount of tax to be paid. In that respect, we could either trigger a sale, so we're triggering an internal sale of the shares, and those shares can go either directly to a new discretionary trust, or they could go to a company. All of the shares are held by a discretionary trust. One of the reasons that we may want to do this in terms of restructuring and triggering that sale is then we're removing that individual ownership of the shares. And so if our risk individual who continues to be our director is sued for reasons other than relating to the business, for example, then the value of the business is still safe. The idea of either doing it directly to a trust or directly to a company holding a trust is we're wanting to perhaps implement that two-tier type structure where we can then declare dividends down from the trading company to the holding company. But either option it needs to be considered with the clients and should be raised with them. Once we've got this structure in place, then we've also got some tax flexibility if we're declaring dividends out of either the holding company or directly from the trading company to the new shareholding trust. So we're potentially improving our client's position there. Dealing with the capital gains itself, so we have an internal sale. Even if we don't pay market value for it, the market value substitution rule will apply to say that we have effectively disposed at the shares at market value, and we have a corresponding CGT liability. Now, dealing with that CGT liability would be potentially using a combination of the CGT general discount, so our normal 50% discount, and then also using CGT small business concessions. From a mathematical sense, for a sole shareholder company, we can deal with a market value of up to 2 million using a combination of concessions. Or for a mum and dad type scenario, we could deal with a market value of 4 million using those concessions again, and still end up with a no tax outcome for the clients. So in terms of how it may look, everything always looks better with diagrams. In this scenario, we've got our shareholder, who's an individual who holds all our shares in TradeCo. We would trigger our internal sale to HoldCo, all of the shares of which are held by a discretionary trust, and then look to apply our CGT concessions. So first of all, discount capital gain. If the individual has held the shares for more than 12 months, that's a 50% discount on the capital gain. A straightforward concession, and one that's not hard to meet as long as we've held the shares for more than 12 months. In terms of the small business concessions, and if you get the opportunity to download synopsis that's been provided, there is a lot of detail in there in relation to the small business concessions, but just to touch on them on a high level in terms of this restructure. I don't intend to go into the detail that's in the paper, but just to touch on them on a high level, we're selling shares in TradeCo. So the small business entity test or the turnover test is not going to be relevant because it's very unlikely that our shareholder is carrying on a business themselves. And so we're looking more at the maximum net asset value test of $6 million. Recognising also that with the modified net asset value test, because we're selling shares, we need to also have TradeCo either be a small business entity or it itself meet the maximum net asset value test, and 80% of the assets of TradeCo need to be active. If we can tick our boxes in terms of the CGT small business concessions, we could potentially use the small business 50. And so I'll use that $2 million figure that I said before would be a maximum amount. 2 million is reduced to 1 million gain by the discount gain, the 50% discount. Small business 50 reduces it by another 50%. And then potentially we could use the small business retirement exemption for the remaining 500,000, meaning out of that $2 million transaction, no tax payable. And just bearing in mind with the small business retirement exemption, if our client is under 55, they need to contribute that amount to superannuation. If they're over 55, they don't. But potentially we could mop up a fair chunk of that capital gain. And for those clients under 55, the question then is, well, do I pay tax on the balance? or do I contribute that amount to superannuation? But that is, as I said, one way of moving our client into a structure where we've now got trust ownership at the bottom. We've removed that individual ownership. And in this scenario, with this diagram, we've got that two-tier structure. So Tradeco could declare a dividend down to Holdco. That's tax neutral. Tradeco tax 25%, Holdco 25%. And we could take our retained profits down away from our trading entity. There's also an advantage that potentially could come about using consolidations, which we'll touch on later on in the presentation, but that could be option one. Benefit, removed individual ownership. In this scenario, we've got our two-tier ownership, so we can bring retained profits down away from trading risk. Tax neutral, if we can deal with the capital gain in the manner that I've described, then the exercise itself is tax neutral as well. Our second CGT rollover is 122A. And so this is where we have an individual who's holding a CGT asset, and the requirements of 122A, and the CGT asset in this case will be shares, is that we dispose of our CGT asset, which is shares. It can't be what's called a precluded asset, which are things like trading stock and other types of assets like that. The consideration they receive is non-redeemable shares in the company that they dispose of the asset to. The market value of the shares must be same as the value of the asset that are issued. Both the individual and the company to which you're disposing the shares of to must be Australian tax residents, and the company itself can't be tax exempt. So we can't transfer this to a charity, for example. Again, returning to our diagram, we have Tradeco, all of the shares of which are held by an individual. We transfer our shares in Tradeco to Holdco, which then issues us ordinary shares or non-redeemable shares equal to the market value of the shares that we transferred. We're Australian tax residents, it's not a precluded asset, and so we'd meet the requirements of 122A. What we're left with is this two-tier structure. So Tradeco could declare dividends down to Holdco. Again, that's tax neutral because they would share the same franking credit rate, and it would allow us to remove our retained profits from risk of Tradeco. One thing it's not going to do is increase our tax flexibility if we're taking dividends out of Holdco, because we've still got the individual ownership, and we've still got asset protection concerns in relation to that individual ownership if our shareholder is also our risk individual. Say, for example, if they're the sole director of the company, we're not really achieving anything from an asset protection perspective by having them at the bottom of this chain, because if they're sued for something relating to the business, then the entire value of the business is at risk. Also, something to bear in mind, and this comes into play whenever you have a two-tiered structure, is that if we have insolvent trading by Tradeco, then the holding company can be effectively deemed liable for that, and the assets of the holding company could be at risk. So you get that in any sort of two-tiered structure, but it's also a consideration in terms of or something that we need to discuss with clients. So a straightforward option here. If our main concern was removal of retained profits from the risk of Tradeco, this would be an effective strategy. As I said, it's not ticking all of the boxes from an asset protection perspective.
Sorry, Adrian, do you mind if I jump in with a couple of questions before you move on to the next restructure option?
Yep, go for it.
A couple of questions on the first option being this internal sale. Mm-hmm. If there was a sale of equity or a sale of shares, question from Derek, would the holding company need to pay the individual the $2 million, for example?
So, yeah, the short answer is it depends. You don't have an obligation to pay it. You could, in essence, gift the shares to the company. However, what you may want to do is effectively vendor finance it in. So you are selling it at market value. And that way, if there are excess funds in Holdco, you can use that to repay the market value. Or potentially you could use some of those funds to make a contribution to super. Probably best approach and you don't see it very often that it is a gift. You tend to see it more at that market value with that vendor finance, because then it allows that flexibility down the track of getting those funds out of the company. Bearing in mind, though, that is now an asset of the individual. So from an asset protection perspective, we've still got that potential asset there until it's paid out and potentially dealt with. But it is probably the better approach.
Thanks, Adrian. Then just a couple of questions from Max. The first one being, could the 15-year exemption also apply if there was that internal sale?
In short, yes, if you qualify for it, bearing in mind there are age thresholds that you have to be over, as well as it has to be in connection with your retirement. Doesn't have to mean you've got to retire, but you've got to show that it's a restructure that's in connection with that retirement process. So potentially that's something that you would look at for family succession planning and those sorts of things as your reason and your rationale why it's in connection with your retirement.
Thank you. And then just the last one for now. Wouldn't holding company have a 30% tax rate because it's just deriving passive income?
No, because it's holding more than 10% of the voting shares in TradeCo, so you would continue to have the same tax rate as TradeCo on dividends declared down to it.
Sorry, just one more question snuck in from David. If you're under the age of 55, say you're 53 years old, could you potentially apply the 2-year rollover until you are 55 and then be CGT free on that disposal?
Yep, and that's a good point, David, and that's definitely something that you could look to do. So what David's talking about there is, as he mentioned, you could use small business rollover, which you just need to qualify for small business concessions to do that. You have a 2-year time period in order from the CGT event to acquire a replacement asset. If you don't, then you have a CGT event. If you're over 55 at that time, then you don't have the obligation to pay that amount into superannuation.
Thanks, Adrian. That's all I've got for now.
Okay. Moving on to 615. And I've got the note there, we use 124M, which is scrip for scrip if it's not met. This is where we have more than one shareholder. So you've got your mum and dad type scenario. You can't use a 122A rollover for that because you're not going to meet the requirements. So you're either going to use 615 or 124M. You use 615 first, and then I'll explain why you would use 124M as we go through the requirements. So those requirements are that we have more than one equity holder. We're exchanging equity holders must own all of the shares. The only consideration received is non-redeemable shares in the interposed company. The percentage in the market value must equal the original holding. Have a whole number of shares owned. All shares in the interposed company must be held by the interposed company sole holder. So that's where you would use 615 initially, but then if you're rolling a second company with different second company shares into that holding company, that's when you'd have to look at 124M because we're not going to be able to meet that requirement. We've got Australian residents, or it's taxable Australian real property. You have to hold the shares until what they call is the completion time. So that's effectively the end of the restructure. And all parties make a written election within 2 months of the restructure that they're applying 615 or 124M. Again, coming back to our diagram, relatively simple diagram. We've got TradeCo. All of the shares are held by 2 individuals. They transfer their shares in TradeCo to Holdco. Holdco issues them shares that have to be the market value, the same proportion, and we're effectively slotting in that company in the interim. Again, same issues as with the 122A rollover in terms of we've still got individual ownership down at the bottom. However, we are creating that dividend trap for Holdco. And if that's what the clients want to do, then that's potentially, that's going to meet that objective anyway. I mentioned the benefits, no change in the tax rate, and the negative still in individual ownership and insolvent trading liability. Same applies to 122A, as I said. 328G, which is the small business restructure rollover. So that's where we have what they call a genuine restructure of an ongoing business. each party is a small business entity, so that's the turnover test. Underlying economic ownership is unchanged. A CGT asset, that is an active asset. And sorry, I should have said with that turnover test, that's our 10 million turnover. That's not the 2 million. They're Australian residents and both choose to apply the rollover. The two areas that cause the most concern when we're looking at the requirements of 328G is the genuine restructure of an ongoing business. What is a genuine restructure of an ongoing business? The ATO take somewhat unfairly the view that family succession planning is not a genuine restructure. However, there is a carve out there that says if our structure is held in place for 3 years after we do our restructure, then it's deemed to be a genuine restructure. So even if the only reason we're doing this restructure is for tax reasons, if we hold it together for 3 years, it's going to be a genuine restructure of an ongoing business. The other concern is underlying economic ownership unchanged. And so if we have the situation where we're moving from individual ownership of the entity and we've got a new entity with trust ownership, we're changing our underlying economic ownership. However, that can also often be addressed by implementing family trust elections in that circumstance. So having a look at it from a diagrammatical format, 328G could potentially allow us to restructure our trade co so that we move the business out of trade co into new trade co with a trust holding the shares. Now, recognising that in some states we still have stamp duty on business assets, and so we need to take that into account. No GST. It's a restructure of a going concern, so we don't have GST issues. But potentially a way of moving our business out of our trade co, which we're not that happy about, and moving it to new trade co with our trust holding the shares. As I mentioned before, it's very likely that we'd need to do a family trust election for that trust, nominating the same individual as the test individual as who originally held the shares. But if we meet those other requirements in terms of residency, then we can show a genuine restructure of an ongoing business, or we hold this structure in new trade co for more than 3 years, and we're deemed to be a genuine restructure, then that's potentially also a further tax-free way of moving a CGT perspective, of moving our business out of trade co into something that's structured a little bit better for clients moving forward. Other options, and there's always other options. One is just to leave it as is. So we've identified a risk, we've identified some asset protection concerns, we discuss it with the clients, we give them options, we talk through the positives and negatives, they decide to leave it as it is. It's their call at the end of the day, but you've given them really the best service there in terms of giving them those options so that they're at least aware of what they can and can't do. We could also declare the dividend. If our concern is our retained profits sitting in our trading entity, we could declare the dividend and accept the top-up tax cost. Again, not something that many clients would want to do, but some would. I guess the other negative of that sort of approach is that aside from paying additional tax, then we've got this dividend and individual ownership. Whatever we do with those funds, we're subject to clawback if that individual goes bankrupt. So it's one of those things that, okay, it is an option. We should discuss it with clients, give them some idea of cost in extra tax, and they can decide. Transfer the assets themselves. So this would be the type of scenario where we have, for example, a business premises and a business within the one company. We might decide to move one of those assets out and take the tax cost of that, or deal with it using CGT concessions. Perhaps we're paying stamp duty on it, depending on the state and the asset. But again, it is an option. If we're transferring from one company to something other than a company, we need to make it at market value. Otherwise, we're going to have Division 7A issues. So that's something to consider as well. And the last option may be the use, if all we want to do is deal with our retained profits, is the use of dividend access shares. So stepping through the last one, the dividend access shares, which I'll come to a diagram. If we create some special class of dividend access shares within our trade co, we issue them to reserve co, we could then declare dividends of retained profits away from trade co down to reserve co. We've got all the shares in Reserve Co held by a trust. So we've got that asset protection perspective there. With that, it would be a good way of removing those retained profits from risk of trading entity without too much additional tax. Now, I say too much because if our trade co is taxed at 25%, this share issue will not have 10% voting rights because we want to restrict our share rights so we're not having a value shift. And so this will be taxed at 30%. So we will have a 5% extra tax paid on any dividends that we declare from Trade Co to Reserve Co on our dividend access shares. Now, I recognise that you can potentially get those back when you declare a dividend out of Reserve Co, but it is an additional cost that the clients will need to consider when deciding if this is an option that they want to undertake. It's a relatively simple structure to implement. The mechanics behind it is quite technical and quite difficult in terms of the tax analysis, but structured correctly. And with our terms of our shares structured correctly, we don't have any value shifting issues, we don't have any CGT events, and we're able to do it in I call it somewhat tax neutral because we have that extra 5% tax on any future dividends, but doing it in a somewhat tax neutral way. So again, if our objective is to move retained profits away from the trading entity, this may be an option for clients. Of course, in any of these restructures where they're moving those retained profits away and they want to lend the funds back, they can do that, and they can take security over that loan. But this may also be a further option for the client to consider.
Sorry, Adrian, just a couple of questions if you don't mind. First question from Peter. If we're applying the 328G rollover, how would it be taxed in the first year of the 3-year period?
How would the new company be taxed?
Yeah, not quite sure.
Well, I assume that's the question, but it'll come back to your analysis of your small business entity tax rate, and in your first year of trading, whether that's a 30% or a 25%. So, yeah, that's all I can say on that one for now.
Next question from Derek. Again, if we're applying the 328G, do you lose access to the 15-year rule?
My recollection off the top of my head is that you do. So again, that's a consideration. You don't lose it for some of the other rollovers discussed earlier, but my recollection you do for the 328G. I'd have to double check that though.
Thank you. Next one from Xander. Would it be possible to transfer the shares in Trading Co to a trust without having a holding company interposed?
Yeah, it can be, and that may be what the clients decide to do if they don't want to have that holding company structure.
Questions are rolling in now, so I'm going to keep you a bit longer.
Yeah, that's right.
Next one is from Rory, saying that if the reserve company owns more than 10% of the voting rights in a subsidiary, would it not maintain a 25% tax rate?
Yeah, it would. So this is in this dividend access share scenario. If you have the rights of those shares that they have 10% at least of the voting rights, then your 25% tax rate flows through. I guess one of the trade-offs of that is, are we creating value in those shares by giving them a 10% voting right? And are we causing some issues there, or putting a better argument there for the tax office to say that there was a CGT event or a value shift on issue of the shares? So it is that kind of trade-off there.
Thank you. While we're talking about dividend access shares, just a general comment from Simon that you might want to address. He said that my understanding is that the ATO doesn't like dividend access shares.
Yeah, so the ATO started an audit program on dividend access shares in 2012 or thereabouts. I guess the short of it is what they were looking for is not really what they thought was happening with dividend shares was not actually what was happening with them. So they were looking at them being used in all these sorts of creative ways. So perhaps issued to a loss company or an overseas resident, and you don't pay further tax on that dividend. And so we certainly had clients that were audited as part of that program where they used dividend access shares in this type of arrangement here, where we're going to a company with a trust, aside from the case of Hayes that I'll talk about in a second, no clients had any issues with the tax office in that scenario. And so they certainly looked at it. They looked at it for a few years, kind of got very excited about it, but then kind of went, well, actually, no, they're actually being used for very legitimate purposes. And the tax analysis behind them is very strong, so we're not going to take any further action. So there certainly was that audit activity, which Simon probably remembers. But certainly our experience is that it's a bit of a cold issue at the moment. As long as you've got your share class rights correct, then no issues from the ATO perspective. And they're going too far off topic. I had a conversation not too long ago with the ATO officer who was in charge of that audit program, who's now no longer with the ATO and is in private practice. And he uses them in his own structure to deal with some family law issues. So I'm not saying that makes it right, but there you go.
Thanks, Adrian. Just two more questions for the time being. While we're on dividend access shares, if we're doing that share issue to the reserve company with limited rights, how can we structure that without triggering a value shift?
So there's a couple of different ways. The first question for a value shift is, what is the value of the shares that are being issued? If we have shares that have no rights to capital, have no voting rights or limited voting rights, have no rights to a dividend unless they're declared with the consent of the ordinary shareholders, have no rights on wind-up, then arguably there's no value there. And so we can't have a value shift. The counter of that may be, well, we could argue that there's a value there because we know there's going to be a dividend in the future. This is a closely held family group. We know these shares are going to get a dividend, so we say they have value. But even if you make that argument, there is a carve-out within the value shifting regime that says that if whatever happened to cause the value shift, so in this case the issue of the shares, is no longer in existence within 4 years, then there's deemed to have never been a value shift. And so if we have our share rights so that the right to a dividend ceases after 47 months, then we have that further protection of that carve out there. What that means in practice is then we need to reissue new shares after 4 years, but it is a way of doubly protecting that argument to say that these shares have no value, so there can't be a value shift.
Last question is from Martin. If we've got a partnership of two individuals, is it possible to restructure that to a partnership of two trusts by using the small business rollover?
I can't see why not. I mean, you certainly could. You would restructure the partnership. One thing that you may want to consider is, the Gallen/Everett assignment, which says that our income from our partnership is effectively determined at either the end of the financial year or when the partnership terminates. If we do a partial assignment of our partnership interest to a trust, then at the end of the year, we could effectively run the majority of that partnership income through the trust. And, that's well-settled law. Gallen and Everett has been around for some time, but I don't see an issue. There is the potential to restructure the partnership from individuals to partnership of trusts. And then the question is, well, do we say for this year, do we assign 90% of the partnership interest? And then 90% of the income for the year will be in that trust, regardless of when that assignment is, when we strike our accounts at the end of the year.
Thanks, Adrian. I'll let you get back to it.
Okay. So those were our options. One thing to consider and this is really relevant on that first option, being the sale of shares at market value. If we later consolidate for income tax purposes that group, so we've got a sale of shares from the individual to another company that holds all of the shares. I can't recall whether I've got a diagram. Looks like I do. So this is the type of scenario. We would then have Holdco holding all of the shares in Tradeco. If we form a consolidated group for tax purposes, what we have to do is calculate our allocable cost amount calculation for our CGT assets. One of the steps in that is that for our ACA calculation, one of the steps is, well, what did Holdco pay for the shares? In this case, market value. So as you work your way through, what effectively happens is that the cost base of the company assets are reset to market value. So where that is potentially an advantage in the future, and I'll use a figure here, let's say 2 million sale to Holdco. When we consolidate for tax purposes, the CGT assets of Tradeco get reset to that 2 million market value, plus or minus some other things, but let's just call it market value. If we then sell the assets of Tradeco for 3 million, obviously we're only paying tax, well not obviously, but we're paying tax on the difference between 2 million and 3 million. So there's an advantage there for the clients. The other advantage from a tax perspective is that if we had done that sale by vendor finance and we've still got that $2 million debt, we would have our 3 million come into Tradeco, pay tax on the extra million, could move our 2 million down to Holdco and then repay our vendor finance loan. So it's a much more efficient way of getting funds out of a company. And that earlier question, one of the reasons why you might want to vendor finance those shares in as opposed to make it a gift. However, we need to be careful dealing with consolidations if we're using rollovers, so 122A or 615. Often that will cause an issue because our first step is, what did the company pay for these shares? In a rollover, it didn't really pay anything. So often there's ways to get around it, but if we don't, we have a CGT event on consolidation. So just a cautionary tale there to be careful. Consolidations doesn't fix everything. It is a complicated area. We need to be careful. I mentioned the case of Hayes before, this was a wider family group of 4 brothers. It's had a long-running history, and Cleary Hoare did the initial work in relation to the actual restructure, and it's continuing to work its way through the court process. Unfortunately, the taxpayer has won pretty much every level. However, the tax office keeps coming back. Initially, they were pursuing them over a particular aspect of the structures that were involved. They lost on that, and they've come back to an anti-avoidance type argument. Again, they've lost, but it's now back before the tribunal again for further consideration. So with this one, to cut a very long story short, you had, as I mentioned, 4 brothers who had commenced a number of different businesses. But the rationale behind them was they always wanted to share in the value equally. No matter what the brother did in what business, all of them share equally in the total family value. And they're very much in terms of sort of reinvesting capital, not taking much money out, reinvesting so that they could further grow and buy more businesses. And so they had a range of different styles of businesses. When these were set up, as sometimes happens, not all of the brothers were in town at that time, or some were unavailable. So you had companies that had become quite successful in trading that might have only 2 of the brothers or 3 of the brothers as shareholders, as opposed to the 4, which was always their intention. So one of the steps that was taken to deal with that was the creation of dividend access shares, and they were issued to 4 buckets representing the 4 brothers. And the values amongst the group were, as much as possible by way of the dividend, equalised, so they each had an equal amount in their bucket. Now, as I mentioned, the taxpayers in this matter, in terms of what they had done in the past, is that they'd never really taken dividends out of the company. They'd reinvested it. And so after the restructure, what the court looked at was, well, what did they do after the restructure? Did they take the dividends out now that they were in these buckets that had trusts as shareholders? Well, the short answer is no. There was a small amount that came out in comparison to what the amount of the dividends were. But that's an important consideration and an important thing to look at when you're doing these sorts of restructures is what sort of dividends was I taking out of this structure before? What am I taking out after? Could the commissioner argue that I only did this in order to get a tax benefit? Now, in this case, the court found no, that they didn't do it just to get the tax benefit, and they could show through their history of their group and the history post-restructure that it wasn't done to get that benefit of the dividends being in these other entities. Now, that's an important reminder to say your work doesn't end after the restructure's done. You've got to bear in mind that anything that you do, any sort of tax planning, is reviewed, 2, 3, 4 years down the track. And so, of course, they're going to look at the things that have occurred afterwards. But important points are to recognise that, okay, well, even if we're doing these things, we do need to bear in the back of our mind that if somebody looks at it, they will look at what we did after the restructure was implemented. So coming to a case study, just to run through a couple of the different options we've been through and what we may look to do or not do. So we've got Robert Apostle. He operates a construction business in a company he's the only shareholder. He's also bought the business's premises in the same company. Over the years, the construction business has been quite successful and has large retained earnings. He's paid off all the debt on the business premises. So we've got a nice valuable asset in that business premises. He's had a few family disputes, was originally involved with his family, wider family in terms of the business. They've had a falling out and a dispute, had some tax issues because of that. And so he's recognising, or he and his advisor recognising that this is not the best structure to be in. So what could we do? So coming back to our options, equity sale, 122A rollover, 328G dividend access shares, and how each of those could work. So in our first scenario, we could sell the shares to Holdco with the trust. With that, it's going to depend on what our market value of our business, together with the market value of the building, along with other aspects as to whether this is an achievable process from a tax perspective and not paying too much tax. The advantage of doing this, as I mentioned before, is that then we've got a trust holding the shares. We've got that two-tiered structure in this scenario, so we could bring the retained profits down away from TradeCo down to Holdco. We may also have the ability to move the building out of TradeCo to Holdco using stamp duty relief, and potentially, if we're consolidating for income tax purposes, that could be done without CGT as well. So it gives us a lot of options. For Robert, I think the main issue is going to be what's the value of the business plus what's the value of the company, of the property, and can we do this in a most tax neutral way that we can. It's definitely an option for Robert. Second one would be the 122A rollover. So a much simpler approach. Again, we could then deal with the retained profits of Holdco. We'd, of course, have the negative of the individual ownership still at the bottom. Again, potentially we're putting ourselves into a position where we might be able to use restructure relief under the stamp duties regime to move the building out of the TradeCo to Holdco. In this scenario, we'd still have to consider CGT on that, so that may not still be a viable option. But it's certainly something that would deal with our retained profits being up in TradeCo if they've been built up over the years. Another option may be the 328G rollover, and recognising in some states we still have stamp duty on transfer of business assets, but in the other states this may be a way of moving the business away from the from the building ownership and doing it in a tax neutral way. So say in New South Wales, for example, we could leave our building in TradeCo, still have the individual ownership there. We transfer the business out using 328G to new TradeCo with the trust holding the shares. We meet our requirements, CGT free, no stamp duty. So maybe an option there for Robert from as I said, it's a tax neutral way of doing it in states that don't have duty on business assets, or in the other states you may consider doing it anyway, just to move it away from having the mixture of property assets and business assets within the one company. But something there to consider as well in terms of a potential restructure. And the last one may be that we use our dividend access shares. Again, this will only really deal with our retained profits and moving them away from the trading risk. Again, unless we've got 10% voting rights, we're going to have a 5% uplift on that dividend in terms of tax to be paid. And so again, but it is an option. So with all of those options, those four options there, they all have the positives and the negatives. And they all, so it is a trade-off of having a look at what's the client's major concern, what's something that we can do to alleviate that or to eliminate that, what we may not be able to get our best practice restructure in terms of a sale of the shares due to other tax issues. So then we may need to rely on the other ones. But as I mentioned earlier, it is a case of working through these different options so we can work out with the client which one we think is the best one for them, because at the end of the day, we're here to give advice and we're here to tell clients what we think the option is that they should take. But hopefully today, recognise that there are these variety of options there, and of course there's even more options when you start digging into it and thinking about it and thinking of client circumstances. But those are the main ones that should be getting considered for clients who have valuable assets or valuable businesses in companies with individual ownership. And I'm going to have a drink of water at the moment, Kate.
That's understandable. There are 4 more questions if you're up to answering them. And then I think we'll cut it off there. If there's any further questions, you're all welcome to reach out to Adrian or I, or if you've got any client circumstances that you think could be useful for any of these types of restructures. But just in the interest of time, we'll work through these 4 questions and then we'll close it up, I think.
Yep.
So the first one we've got from Xander, just going back to the dividend access shares. Question is, can you only use those dividend access shares for retained profits that have been built up within the company when you issue those shares, or can you also use them for future profits generated by the company?
Yeah, you can still use them for the years after for those profits. Again, bearing in mind that they will lose those rights to dividends within 4 years if they're drafted that way, and you may have to issue some more. But it's best practice, obviously, to try and clear out that company as much as possible with those retained profits so you don't have them sitting in a trading entity. And again, bearing in mind the Hoare situation, that continues to show that story of why you've done it as opposed to tax reasons.
Next question is from David. If we've got an individual, a sole trader carrying on a business, is it possible for them to roll over into a trust structure?
They could, using the 328G restructure.
All right, and then we've got 2 questions on the CGT concessions. Just a clarification requested from Brenda. She said, when you spoke about the $2 million test, did you mention that it was an issue where there is an individual shareholder?
So if you're an individual shareholder and you're disposing of the shares, the question is, well, who's the taxpayer disposing of the shares? It's the individual. Are they carrying on a business themselves? No, they're not. Even if they're carrying on another business as a sole trader, they're not carrying on a business. And so you can never rely on the small business entity test when you're disposing of shares held by an individual. And so you have to rely on maximum net asset value test, and then the modified version of that as well.
And then the last question from Kirsten. If Trading Co.'s assets are more than 80% cash, can they use the small business concessions for an equity transfer?
Depends on where the cash was generated from. If it's in essence cash linked to the business, then I would say yes. But if it's passive cash that's come from share investment or something along those lines, I'd say no.
Thanks, Adrian. And thank you for presenting today's webinar. Hopefully everyone learned a lot about the different restructures that are available, and hopefully get some use out of them for your clients that may have not been structured the best way to begin with. So there will be a feedback survey that's circulated by email later today. If you could just take a couple of minutes to complete that, and also give us any suggestions for future topics that you would like to hear about. They're always very welcome, and we do take those into consideration when working out what our next webinar will be. But otherwise, thank you all for attending today's webinar. We hope to see you in the next one. And Max, I do see your question on there. We'll come back to you separately. And as I mentioned, any further questions, feel free to get in touch. Thanks, everyone. See you next time.